Hello and welcome to this Association of Corporate Treasurers webinar, sponsored by Clifford Chance, where today we will be discussing the latest developments regarding LIBOR transition. Late last year, the FCA and PRA sent a letter to the CEOs of the largest financial institutions requesting that they explain to the regulators their plans for transition. This has, arguably finally, focused the markets on LIBOR transition. And the purpose of today's webinar is to provide an update on the progress that's been made to date and what possible next stages may be. As is often the way with developments in the financial markets, many things are outside the Treasurer's control. Nevertheless, corporates need to be aware of what the transition away from LIBOR means for both their Treasury activities and the wider organisation, as LIBOR is pervasive through many corporations. They also need to identify what the steps might be that are needed to ensure a smooth transition for their organisation. And talking about that is the purpose of the webinar today. So, over the next 45 minutes, we're going to set out what's happening and why, share some information about the latest developments, and touch on some of the challenges for corporates. As is always the way, we would like this session to be as interactive as possible. So please submit questions as we go through, and we'll endeavour to cover off as many as we can. You'll see a button on your screen that allows you to submit questions, and we'll try to track them as we go along. So please don't wait until the end to send them in. And if you do ask a question, we won't mention your name or company, so please feel free to ask anything, well, within reason, obviously. Anyway, moving on. Before we start, let me make some introductions. My name is Sarah Boyce, and after many years of working in corporate treasury, I now provide policy and technical support here at the ACT. And today I'm delighted to welcome three very experienced partners from Clifford Chance, Paul, Peter and Anne. Paul Deakins is a partner in the Debt Capital Markets Group here in London and is a member of the bond subgroup of the Sterling Working Group on risk-free rates. Peter is a partner in the banking team and specialises in investment-grade finance, leveraged finance and restructuring work. And Anne is a partner in the Derivatives and Financial Regulation Group, which focuses, as you might guess from the name, on derivatives and structured finance, asset-backed securities and hedging aspects of those. I'm also delighted that we are joined by Kwok Liu from National Grid, where he is Deputy Treasurer of Funding Investment, to offer us a corporate perspective. Kwok is also a member of the Sterling Working Group on risk-free rates. So, as ever with this topic, we've got a lot of ground to cover in the next 40 minutes or so. And so, firstly, Paul is going to set the scene for us by giving a brief overview of the current initiatives, before his colleagues will give us an update on developments in the various markets, and then Kwok will give us some insights into some of the challenges that he is facing before we turn to a more general discussion. So, to get us started, Paul, where are we now?
Thank you, Sarah. Yes, I think you'll see from the slide that the main point is that this remains a genuinely global issue on one of an almost unquantifiable scale. I think as early as 2014, the Financial Stability Board had estimated the notional volumes of LIBOR-linked exposures to be well over $200 trillion US. I think every estimate we've seen since has added to that number. So the size and the complexity of the issue is really quite daunting. But against that backdrop, I think it's fair to say we've started to see some progress, not least that if you look at the sort of major currencies and jurisdictions, the choice of replacement rates has been made, and working groups are underway in each of the currencies looking at the more practical details of implementation, albeit that some of those are really quite challenging. For example, this question of what kind of spread adjustment methodology you'd put in place to transition from what are currently forward-looking term rates with an element of bank credit spread embedded to the overnight risk-free rates that are basically the favoured solutions across all of the major currency groups. Another sort of element of good news, I think, is that we've now got an alignment of time zones or sort of time horizons between the Eurozone, the US and the UK. It was the case that the transitional period under the EU benchmarks regulation was going to signal an end to LIBOR potentially as soon as the end of this year. But actually that deadline has been pushed out so that all of the major currencies are now working towards the end of 2021, and indeed potentially we may see a reformed Euribor rate even sooner than that. I think that flows on to what we're seeing in terms of some tangible outcomes in specific products. I'll touch in a moment on SONIA and SOFR bond issuance, for example, which is to some extent a success story of the reform project. And we've also got the ISDA benchmark supplement and the work that ISDA is doing to give shape to the derivatives market. But I think the big caveat that is most important to our audience today is what you see with the working groups and the product initiatives. They're very much dominated by financial sector participants or the buy-side investors. And I think there's more of a sort of impediment to engagement from the corporate sector for a variety of reasons. I think the most obvious is that the regulatory oversight directs itself towards the banks and the regulated sector through the policy tools that regulators have at their disposal, and they are very much the catalysts for the reform agenda that we're all trying to get to grips with. But it's also fair to say that there are some pretty significant practical issues that are contributing to a more limited adoption of the new benchmarks by the corporate sector, and we'll focus on those for the remainder of this webinar. Not least among those is this critical question as to whether forward-looking term rates are going to be developed from the risk-free rates such that these new benchmarks will function in a practical manner that mirrors the current calculation and payment timings that you have in IBOR-linked instruments. Now, they're part of the Sterling Working Group's work plan for 2019 and also firmly on the agenda for the Alternative Reference Rates Committee in the United States. Although it's interesting to see that the ARC's messaging is now somewhat more muted in terms of how quickly a derivatives market might develop in order to assist with the construction of term rates, and whether they're actually a desired replacement at all or simply be the first in a menu of available fallbacks. And there's quite an important philosophical question at the heart of this as to whether term rates are indeed necessary at all. If you look at the next slide on the SOFR rates that ARC put together, I think one of the interesting themes that comes out of that is if you compare the volatility of these overnight rates versus a daily LIBOR fixing, you see a much lower degree of volatility in the overnight rates, particularly if they're averaged or compounded over a term. And therefore, to some extent, there may be a trade-off between the certainty that a forward-looking rate brings versus potentially having a more stable underlying rate, which might be better from an all-in cost perspective. Now, that's clearly a challenging proposition for a number of reasons, but it's a theme we'll come back to during the course of this webinar. I think suffice to say now, the fact that the prospect of term rates is being discussed at all is in many ways one of the main impediments as to why people don't currently want to move to risk-free rates right away. You don't know what the consensus is going to be for each particular product. And so there's a strong desire for people not to make the wrong choice, just as there is to make sure that they're not left behind. This comes to a head particularly in areas of interrelationship between products, particularly hedge accounting, for example, where at the moment this uncertainty between the derivatives market, which is very clearly going to embrace overnight rates, and the cash markets who potentially are still looking at term rates, means that from a hedging perspective, you can't say at the moment that you're definitely going to move to the same solution or at the same time. And so whilst the IASB has proposed some relaxation on a transitional basis to enable the transition to take place without sort of complete disruption to current accounting treatment, it remains unclear what will happen if those markets ultimately land on different permanent solutions, or indeed how the transitional period will be brought to an end. So there's quite a lot of complexity deriving from those interrelationships that still needs to be worked through. So I guess in light of all of that, it's a slightly unfair question then to hand over to Peter to say, actually what are we seeing people doing in the loan market at this stage?
So I think when it comes to the loan market, for anyone who expected a vibrant market with a lot of products being offered covering compound, SONIA or other things, I think we're looking at a more of a deafening silence at the moment, in that I think the one development in the loan market since the LIBOR transition discussion began has really been the LMA benchmark clause, which allows legacy or new transactions to be amended in the future on a majority rather than an all-lender basis. But in terms of new products being offered, the complexities or the uncertainty that Paul mentioned is very much a blocker in the loan market, in that for sterling it is feasible to do a loan and document it in a way that works for a compound backward-looking SONIA. But it's not a product we see offered widely at the moment. We are aware of one or two transactions being discussed, but trying to implement that type of product on a wide scale is very difficult to achieve for both sides of the market in terms of the system support to do that, the rate calculations, etc. If you're then adding the complexity for the loan product and you're looking at different currencies, you want a forward-looking term rate option, then you're suddenly looking at a situation where it's very difficult to, at the moment, reconcile this into one type of multi-currency facility agreement. And for some currencies, like the Swiss franc, the ability to derive a forward-looking term rate from the derivatives market is very difficult because it doesn't meet the liquidity requirements in order to do so. So at the moment, trying to get the new products to do what is currently capable of being done through the LIBOR market is currently not feasible. In terms of the legacy transactions in the loan market, I think there are really two types. In the first category, you have loan transactions that were documented before May 2018, where a change in the underlying benchmark rate is more likely than not going to be a all-lender decision if you try to amend the document to reflect a new benchmark. And the other camp of transactions is the sort of a growing category of legacy transactions documented after May 2018, where the LMA benchmark regulation clause is used, which then basically allows amendments to the benchmark rate on a majority basis. Now, for both of these types of transactions, you're going to have a more fundamental issue in that once there is a consensus as to which rate is being used, whether it's term, compound, backward-looking rate, or a forward-looking term rate, or something else, there is the spread adjustment question, which is sort of hovers above all of them. And that is something that inevitably is going to require a market agreement or a transaction-specific agreement in order for legacy transactions to be updated and be fully brought to date.
So sorry to interrupt, but just on that point, is it a way that it's envisaged working at the moment that corporates would have to do a loan-by-loan negotiation on that margin piece?
I think the expectation, what the working parties are looking at is ways of trying to come up with a convention in terms of looking at the SONIA rate and the LIBOR and try to identify what the credit spread should be. But that is never going to be more than possibly a statistical reference mark in terms of the spread. Whether or not that's going to be acceptable to the parties on any given transaction is a separate question. And it is a question that if you took a more activist view on what your funding cost should be as a corporate, you might say that we don't think LIBOR is representative of banks' funding costs. SONIA might be more so, but there is a discussion to be had. And I think if you assess the difficulty of trying to non-legacy transactions, on the one hand you have a corporate done by RCF entered into with, say, 12 relationship banks. That discussion is probably more straightforward and in a way easier. But the loan market also covers a huge range of very widely syndicated credits where the lender consortium or the syndicate comprises more than 200 lenders, all of whom have a different view on what that credit spread should be.
Yeah, hence my question, to be honest.
And it is a very different dynamic depending on what product and the way in which you use the loan market. So in terms of timing, what do you do and by when? I think there are market factors in terms of what products are being made available, which will dictate to what extent you can try to implement or update your funding programs in the loan market. And exactly when you try to go to the market and make changes depends on which products you want to use and to what extent you are looking for an easy transition phase or something where more of a win is being sought. I think the other thing that will impact this is for any given borrower, individual circumstances, current maturity, where you are in the cycle, where we are on sort of general credit and liquidity. And there is a sort of prospect where, on the one hand, dealing with legacy transaction is a very simple amendment. On the other hand, it could be effectively a complete repricing, which is a fundamentally different transactions. And we haven't yet seen any part of the sort of financial institution community trying to more actively market product or assistance in that respect across the loan market. But it's one of the things we expect to appear over the next year or two. Paul, would you agree with that sort of general sentiment for the bond market?
Yeah, I think that's very fair, Peter. I mean, the bond markets are in a similar place, although, as I alluded to in the introduction, I think to some extent there's a success story here as well. If you look at the volume of SONIA-linked issuance, for example, I think estimates were that by sort of middle of last month we'd seen 28 transactions with a notional volume just over 14 billion sterling of SONIA-linked issuance. And from the US, the Alternative Reference Rate Committee put their estimates on SOFR-linked issuance at around $32 billion by the end of last year. But of course, with the huge caveat that that's a market that is almost exclusively dominated by financial institutions and supranationals. And what we haven't seen, for all of the reasons you touched on in the loan market, is corporates picking up the baton and issuing SONIA-linked transactions themselves. Even within the bond market itself, you've got very different conventions in terms of how people are addressing this in the UK and in the US. So a lot of the SONIA-linked issuance has followed with a high degree of consistency the overnight compounding formula that the European Investment Bank used in July of last year, which is sort of overnight compounding formula with a 5-day lag between the accrual period and the actual interest payment date, whereas the US deals have a fundamentally different convention based on a weighted average and with a 4-day lockout at the end of the interest period that basically assumes that the last 4 days of the interest period are all identical in terms of the rate. Throw into the mix, as I touched on at the start, that potentially we're going to see a reformed Euribor rate, which might stay as a forward-looking term rate. And you can see for people with multi-currency funding in the bond markets, knowing which way to jump is an incredibly difficult choice. And so actually, in sort of real terms, what we see is corporates who are really split between the addition of expanded fallback language into what start life still as LIBOR-linked transactions, with the idea of having some sort of independent advisor or expert determination mechanism to implement the transition at the point that the benchmark rate disappears and that transition becomes necessary, or frankly just issuing floating rate issuance altogether and relying on the fixed rate market or other funding options entirely until the picture becomes a bit clearer. And that's just on the new issue side, where people have a free choice in terms of what they do to their documentation. And I think we have all of the same problems that you've identified in relation to legacy transactions, where there's a small but pretty significant body of deals that reference LIBOR beyond 2021, but haven't had the opportunity to build in any specific fallbacks. I think perhaps unlike the loan market, though, your conventional bond transaction would default to the last LIBOR fixing and therefore effectively become a fixed rate instrument at the point that the relevant benchmark disappears, which leads to some interesting questions around timing, because if you leave it too late, it simply becomes a sort of bilateral negotiation around your views on prospective interest rate trends rather than a sort of neutral solution to a shared problem. And the regulators are very keen to see what they would term market-led solutions, i.e. A non-interventionist approach that really relies on consensual agreement, effectively consent solicitations between bond issuers and their investors. But that throws up another issue as to simply the costs and uncertainties of running that sort of process. And clearly, before you've got a market consensus on what the replacement for LIBOR will be across bond transactions as a whole, incurring that sort of cost and going through that sort of process is really quite unattractive. Working groups are looking at other options, including how you might streamline the consent process, or whether even a synthetic IBOR rate could be created in order to help legacy transactions run off. But both of those are fraught with a number of difficulties, and the outcomes are pretty uncertain. So I'd say, sitting here now, certainly wouldn't advise people to rely on something coming out of those discussions that would provide a sort of one-size-fits-all solution to this problem. So in terms of the cash products, I think things remain challenging, which I guess, and from a derivatives perspective, at least from the outside, it feels like they have a clearer view of the direction of travel.
Just before we go to that, Anne, sorry, because I think yes, our perceptions of the derivatives are much easier. Do you, Paul and Peter, think that actually this whole process is just going to be an opportunity for contracts to be completely renegotiated? Because ideally, from a corporate perspective, as far as possible, you'd like to just cut and paste, cross out LIBOR, put in SONIA or whatever it is, and move forward. But from your perspective, do you think there's going to be a tendency to have to go, completely rework contracts?
I think for the loan market, it doesn't have to be that. I think it's very much a question of the mindset of individual market participants, and it's hard to speculate, but the dynamic is certainly going to be potentially different between the corporate treasury speaking to its chosen relationship banks, where relationships exist over a longer period of time, compared to more opportunistic investors in more widely traded instruments like term loans, etc.
Yeah, I think it must be true on the bond side as well. I mean, clearly, sort of closely held private placements. It may be that you have investor groups who feel they have a bit more leverage and would like to have discussions about other aspects of the documentation and take a slightly more opportunistic view. But I think in a public syndicated deal where you're clear about the proposal when it comes, and that proposal ultimately seeks to follow as far as possible the outputs of the various working groups in terms of recommended methodologies for the transition, you would hope that you could confine it to a single issue discussion rather than it being a fundamental rewriting of those outstanding securities.
Sorry to interrupt, Anne.
No, it's fine.
Derivatives.
The world of derivatives, it's not often I hear it described as being easier. So I think
I'm a very simple being.
It's widely recognised that in order to facilitate the development of the market in bonds and loans that are bearing interest at risk-free rates, a liquid derivatives market in those rates needs to be developed. And actually, fortuitously, is the published data this week on the volume of the reported transactions referencing the RFRs that were traded in the first quarter of this calendar year. Transactions referencing alternative risk-free rates accounted for less than 3% of the total interest rate derivatives traded by Notional. SONIA swaps represent the majority of those transactions, which is to be expected because SONIA is currently used as the reference rate for sterling overnight swaps. The trading volumes of the rate swaps referencing SOFR, the first of which was executed in Q3 2018, did increase during the first quarter of 2019, but remains relatively small. I think this is also expected because the Fed funds rate, not SOFR, is the current OIS rate in the US, so it's got a bit of a way to go.
And that would really be, that's the logic for that being the reason for the take-up being so much slower in the US.
Yeah. And it was also published slightly later.
Yeah.
I mean, it's probably worth noting that, ESTA isn't going to be published until the end of this year, and there's always a lag between the publication of the rate and the development of the market. So, you've sort of got an idea of the lead time it's going to take to get there. So ISDA's initiatives are focused on facilitating the transition away from LIBOR and the development of the market in these risk-free rate swaps. And for the purposes of this session, I'm going to concentrate on the three highlighted on the slide in increasing order of kind of complexity. The definitions, the benchmark supplement, and then trying to address this issue of value transfer that the others have mentioned already. Firstly, the risk-free rate definitions. As these rates are being determined by the various working groups around the world, ISDA has been developing and publishing the agreed market standard definitions for those rates for use in derivatives transactions, standardised market, standardised definitions. Reformed SONIA and SOFR rate definitions were published last year, and we're expecting others to follow. ISDA is also updating the 2006 definitions so that, amongst other changes, the fallbacks in the standard IBOR definitions, such as GBP, LIBOR, BBA, for example, will fall back to include the corresponding risk-free rate. And ISDA is trying to get the updated definitions booklet out towards the end of this year. Secondly, they published the benchmark supplement. The background to this is that under the EU benchmark regulations, regulated users of authorised benchmarks have to have robust written fallback procedures in their contracts to cover the situation where a benchmark, i.e. LIBOR, ceases to be authorised or ceases to be published. The current IBOR definitions, which have been around for quite some time, fall back actually in derivatives world to a pool of deposit rates from reference banks and then to a market rate for interbank lending. They may be sufficient. I think the market view is they were sufficient if there was a temporary blip in the publication of a rate. You know, one of the screens went down, for example, but they're clearly not fit as a long-term solution to IBOR cessation. I mean, just as an example, in terms of the resources required, if you're phoning up the banks every 10 minutes to try and get quotes from your dealers, that would require an awful lot of resource on their part. And the opaque nature of the quoting process, which of course doesn't really solve any of the problems that the IBOR reform is seeking to achieve. So risk-free rates are contractually more robust than the current IBOR fallbacks, and the idea is that you will fall back to a risk-free rate. The benchmark supplement allows the parties to incorporate it into their ISDA documentation to amend either future trades or legacy trades, or both future and legacy trades, to provide for IBOR to fall back to the applicable risk-free rate if available. And a further range of rate-setting options apply in this supplement. Ultimately, if there's no agreement between the parties as to the replacement rate, then each party has the right to close out the affected transactions at the mid-market rate. The benchmark supplement can be incorporated bilaterally or via the benchmark protocol, which, like previous protocols, is designed to facilitate the amendment of numerous bilateral derivatives contracts via a simple adherence letter rather than individual negotiations. And I think, going back to Sarah's point, this is why derivatives are easier, because there is a mechanism in the market that can be used to amend legacy contracts and actually, using benchmark supplement, future contracts relatively easily. There isn't the bilateral negotiation issue that you have in bonds and loans.
Although I suppose there's a risk or a consideration that, thinking about hedging, if you accept the protocol, you need to make sure that doesn't blow apart what's happening in your loan or your bond.
Exactly.
Yeah.
So the way the protocols work, both sides of the equation have to sign up to it, and in quite a lot of the sort of structured transactions, those counterparties, you know, securitization issues and things won't be doing that. So for exactly that reason.
Yeah.
Exactly.
And so it's probably worth corporates just having in the back of their minds that just don't automatically sign the protocol.
Yeah.
It may not work for you.
Yes, you certainly need to think about the sort of implications of that. And one of the implications is that, of course, you are signing up to a fallback in some circumstances to risk-free rates that have yet to be decided. So there is a kind of evolution that needs to carry on that. And then finally, looking at the thorny issue of value transfer arising in the event that you transition from an IBOR rate to a risk-free rate. Back in July last year, there was an ISDA consultation paper which sought views from all market participants, and they were very clear that they wanted as much input as possible, so not just from the swap dealers, on the methodology to account for the value transfer that will occur when you move from a forward-looking term rate, which includes a credit spread element, to a backward-looking overnight rate, which has little or no credit element and minimal term risk. For certain IBOR. So the ones they covered included LIBOR and Swiss LIBOR. The consultation paper set out 4 options to account for the term change and 3 options to sort of replicate the credit spread. And from the responses, ISDA determined the approach to take would be a compounded setting in arrears rate for the term adjustment. So you'd look at the risk-free rate over the relevant IBOR tenor and compound it daily during that period. And for the credit spread, a historical mid-median approach, which will be based on the mean or median spot spread between the relevant IBOR and the corresponding risk-free rate calculated over a significant static look-back period. Now, to take that forward, ISDA's put out a request to third-party vendors to submit proposals for determining this adjustment spread and publishing it at the relevant time. And my understanding is that what will happen is it will be published on a screen, so when you're looking at sort of what the 1 month LIBOR adjustment would be, you can find it sitting there as at the right time. ISDA's planning further consultations on the adjustment spread methodology to be used for other IBORs, for example, US dollar LIBOR, and to the extent it's relevant, Euribor, in the next few weeks. And they're keen to receive feedback from as many interested parties as possible. I know people have a lot on their plates, but if this value adjustment mechanism is going to be used in the derivatives market, there may be arguments that it should be at least considered for adjustments in the cash markets, and therefore it would be important to at least understand what those proposals are to be able to have the most informed point of view.
Thank you very much. So, thank you very much indeed, all of you, for that update. It feels as though there is some progress being made, although it's possibly a bit patchy still. Quok. She says. So, National Grid, what's been happening in relation to LIBOR transition in your world? Have you started? Do you have a formal program? Have you started thinking about this yet? Or?
Yes, we have. So I think it's really important to understand what the scope of the problem is in the first place. So we've got an inventory of all of our kind of treasury transactions, which are linked to LIBOR. We've also taken the approach that we are going to avoid issuing new floating rate bonds for the reasons that Paul mentioned earlier on. Consensus solicitations are painful and expensive if there's no kind of market standard which is agreed on. And we're also going to reduce our exposure to LIBOR where possible by not only not adding to the problem, but by netting down existing derivative positions where we can. Also ensuring that all of the new loans that we do have fallback language in them. And then in terms of what we're going to do going forward in the nearer term, then we're also going to be testing systems to ensure they correctly capture deals, make payments, and generate the right accounting entries for the RFRs when the systems are ready for that. And also to provide guidance as well to the business on changing interest rates for late payment clauses, for example. LIBOR gets everywhere. You'd be surprised on where it comes up. Late payment clauses, and also for new contracts as well. It's just to kind of give the business guidance on what to do with that.
And are there any particular, obviously, apart from the fact that we don't really know what the new RFR looks like, are there any particular problems that you're coming across, or is it very much a process that you're just working through?
Yeah, so I think systems readiness, So we're very much reliant with our treasury management system on a third-party provider. So until the systems have been updated and are ready to be tested, then there's very little we can do. So there will kind of be reluctance on our part to put in deals referencing RFR, SONIA, for example, until that is the case, because no one really wants to do everything like this on spreadsheets. Can you think of all the kind of problems from that?
Yeah.
Also, actually, availability of products, actually, as Peter mentioned earlier on. So, banks market all sorts of things, all sorts of products to me, just about anything you can think of. But loans linked to SONIA, haven't heard a single thing yet on that. So again, having just availability of products is important as well. And also, as market standards haven't been finalised yet, we've received advice actually, in fact, that it's probably best not to be first in terms of doing a SONIA bond, for example.
Yeah, I can understand. There's really no early sort of first mover advantage in this process, is there? So I guess this might be a question for you, Peter, actually, I'm not sure, but the working groups and the regulators are clearly talking and talking increasingly, dear CEO letter, with what I'd call market makers. Do you think they could be doing more or should be doing more talking to corporates? I mean, I think from our perspective we struggle slightly to see what they might say, but do you think that having the Bank of England opine on something would actually be helpful?
I can jump in on this one. I think the issue is that the regulatory sort of impetus for this has made it very clear that it's not going. They don't want to impose a regulatory solution. They want it to be a market solution, and so you have all these working groups and currencies and all the rest of it, where people are sort of being invited to give their views. And I think they have to be quite careful that they don't, having said that, then direct the market to what they want the response to be. And so to the extent that the market is coming to a conclusion, they are going to, I think, take a more hands-off approach, because it's not within their remit to sort of to do that.
What do you think the banks are actually waiting for then before they start offering products to corporates? Because the conversation we've been having, no corporate is seeing a product being offered to them. So what's the magic bullet? Do we need conventions? Do we need a major corporate to go? I thought that they will, to be honest. But what's the thing? What's the one thing that would make this market start to feel more real and less theoretical?
I think it will vary depending on the currency and the product in a way. But if you take the syndicated loan as an example, it is feasible to do it with a compound backward-looking SONIA. That can be done. The documentation aspect of it is there are changes in the way you would approach a syndicated loans in terms of it is a backward-looking way. It reduces the need for, or possibly putting into question the need for a break, interest break clause, that sort of stuff, which doesn't really become relevant anymore. But I think in order for the financial community as a whole to be offering the products, they need a system support to be able to run the loans on that basis. And I think before people are making investment decisions as to develop the program and software, the support around it, there is a little bit more certainty as a direction of travel. But that's just one example. I think the same fundamental issue applies to other products and currencies.
No, that's helpful, thank you. I'm aware that we're rapidly running out of time here. I think just a final question really for Paul and for Kwok is, given everything that's been talked about today, what do you think corporate treasurers could or should be doing next?
I suppose it's very tempting just to continue with the wait-and-see approach, given the complexity of the issues we've discussed. The one thing I would say is there are benefits in engaging with the transition process to make sure that views corporates have are properly represented and heard within the various working groups. And although while corporates are probably not going to get the Dear CEO letter that the regulated sector has got from the Bank of England and the PRA, they are going to face, treasurers are going to face questions from the CEO and from the board to say, well, institutionally, how are we prepared for this issue, and what are we doing to protect ourselves against the transition? So it's a mix of the things I think Kwok's already talked about in terms of diligence around existing exposures, and they can pop up in some funny places. It could be pension scheme valuations, property lease documentation. It's not just the obvious sort of external funding instruments. And actually having a plan and an overview in place as to when the major milestones are likely to happen. You know, when is the Sterling Working Group going to make a decision on term rates? If I have that decision, what can I then move forward? You know, what could I move forward once I know whether you reformed LIBOR is acceptable? And having a bit of a roadmap for, you know, not just those milestones, but the third parties you'll need to engage along the way. So sort of, you know, tax, accounting, infrastructure assistance, and having just a bit of a game plan, really, in terms of how they're going to approach the issue. We're doing a presentation the other day, and someone came up to me the other day and said words I never thought I'd hear, which was, there aren't enough lawyers in the world to deal with this issue. I'm not sure they necessarily meant that, but I think what it does highlight is, if everything is left till 2021, there's going to be a big pressure on service providers of all kinds, financial counterparties, you know, infrastructure providers to deliver everything all at once. So if you wait till the last minute, the amount of attention and support you're going to get from your advisors and your counterparties in helping to manage that transition is going to have to be reduced accordingly. So, you know, simply waiting to see it is also dangerous, I think.
No, I agree with Paul, actually. I think certainly understanding, you know, what the size of the problem is in your organisation, where possible avoid adding to the problem as well, your exposure to LIBOR, and really making sure that anything you do which is linked to LIBOR, that you have, you know, fallback provisions, the latest fallback provisions in place, and actually have a plan for the transition, a timeline. So, you know, there could be a case where both LIBOR and SONIA are both relatively liquid at the moment, but liquidity in LIBOR could fall off as we get towards 2021. So, you know, have a view in terms of when, if you are going to take a proactive approach into transitioning from LIBOR, when you know, you plan to actually execute a proactive approach, if that's what you choose to do. Otherwise, you might have to rely on the fallback provisions if you wait all the way till the end.
Okay, that's really helpful. Thank you. Thank you all very much indeed. We've actually reached the end of our time. That really has flown by this afternoon. And I don't often say that in a room full of lawyers, to be perfectly candid. Thank you very much indeed for your time and your insights on that. I hope that everybody's found that update helpful and informative, and that we've given you some things to consider, given the fact that LIBOR is almost inevitable. Thank you very much indeed for all of the questions. We have tried to address a number of them as we've gone through, but clearly we haven't got to all of them. And as part of the supporting documents to this webinar, we will produce an FAQs document that will answer many of those that we didn't get to today. Please make sure that you keep up to date with LIBOR transition. As everybody has mentioned, you know, things are now beginning to move on this. We've mentioned a number of resources, but please do talk to your banks. Obviously, there's the ACT has a LIBOR web page which we keep updated, and please feel free to contact us directly as well. There are a number of ACT events coming up, which will include coverage on LIBOR. Particularly, there's a couple of sessions at the annual conference in a couple of weeks' time that you will find particularly interesting. So on that note, I'd like to thank Paul, Peter, Jay, Anne and Kwok, Clifford Chance's sponsors, and finally ask you to take time and fill in the survey that will appear once this webinar finishes, as the feedback that you provide is very helpful to us when we're arranging future events. Thank you very much and goodbye.